6 months at $6,545 per month equals $39,270. 3 years at that same monthly spending equals $235,620. Those are the two cash piles we're comparing. The first buys 6 months of household spending. The second buys 36 months. The difference is $196,350. So the larger reserve needs a specific assignment before you move that much money away from long-term assets. The benchmark comes from the United States Bureau of Labor Statistics Consumer Expenditures data for 2024. Average annual household spending was $78,535, or approximately $6,545 per month. That produces a clean comparison, but it assumes investments must cover every dollar the household spends. Your own calculation begins with spending that isn't covered by income arriving independently of market sales. The amount left over is your monthly portfolio gap. Suppose outside income already pays part of your housing, food, utilities, taxes, and other recurring costs. You wouldn't build the reserve around the full $6,545. You would use the amount that remains after the independent income reaches your account. A smaller gap lowers the required cash balance. A larger gap burns through the same balance faster, which means two households with identical portfolios can need very different reserves. The account size doesn't set this number. The monthly demand placed on that account does. Multiply your monthly portfolio gap by 6, and you get 6 months of emergency liquidity. Multiply the same gap by 36, and you get 3 years of crash runway. The arithmetic looks almost too easy. The purpose of each result is where the decision becomes expensive. $39,270 gives the benchmark household half a year before another funding source must take over. That can provide enough room when the financial disruption itself has a short clock, such as interrupted income or a large expense arriving before money can be arranged on sensible terms. $235,620 lasts an additional 30 months at the benchmark spending rate. It is 6 times the smaller pile, but its purpose isn't to cover 6 times as many broken appliances, surprise bills, or ordinary mishaps. It keeps recurring household spending away from market prices for much longer. A household bill doesn't care what happened to stocks that morning. Housing remains due. Groceries still leave the account, and the utility company won't postpone payment because your portfolio needs time to recover. Once available cash runs out, routine spending can begin dictating which investments you sell. That collision matters most when share prices are deeply depressed. You aren't selling because an asset reached an attractive valuation or because the portfolio needs rebalancing. You're selling because ordinary life has a payment date, which is an irritating way for a plan designed to last decades to lose part of its ownership. The larger reserve inserts time between those two events. Cash handles the recurring withdrawal while depressed shares remain invested. It doesn't predict the market bottom or promise that prices will recover within 36 months. It prevents every monthly bill from becoming an automatic instruction to sell at whatever price the market happens to offer. I built a digital book called The Exit Code to coordinate cash runway with portfolio withdrawals rather than treating them as unrelated figures on separate calculators. The link is in the description if you want the framework I use to connect the reserve to the spending it must support. So your real comparison won't necessarily be $39,270 against $235,620. It will be your monthly portfolio gap multiplied by 6 versus that same gap multiplied by 36, with each amount assigned to a different financial threat. The 6-month number buys time before the household needs another source of liquidity. The 3-year number is meant to stop recurring spending from colliding with severely depressed ownership. That leaves the expensive part of the comparison. What do those additional 30 months purchase when the market is already down 50%? Put a $50,000 annual portfolio gap under the microscope. After income arriving independently of market sales has covered its portion, your investments must supply approximately $4,167 per month. 6 months of that gap calls for $25,000. 36 months calls for $150,000. Those figures describe the same household and the same standard of living. Only the length and nature of the threat have changed. The $25,000 pile handles a near-term liquidity interruption. Earned income might stop unexpectedly, or a large expense might arrive before you can arrange another sensible source of money. Cash gives you room to respond without converting a badly timed problem into an immediate investment sale. If income resumes within that period, the emergency fund has done its work. It kept the household functioning while you replaced the missing cash flow. Expecting it to carry a lengthy bear market gives it an assignment it was never sized to perform. A crash reserve runs on another clock. Nothing unexpected needs to happen inside the household. Your bills can arrive exactly as planned, while the investments assigned to pay them lose half their quoted value. You still have access to money, but getting it from the market now requires surrendering assets at a deeply unfavorable price. That difference becomes tangible on month 7. The first 6 transfers consume the $25,000 emergency fund. Then another housing payment arrives. Groceries leave the checking account, taxes remain due, and approximately $4,167 must appear again. If depressed investments have become the only remaining source, the 7th transfer forces a sale. The $150,000 crash reserve continues covering that recurring gap through month 36. Its extra runway does not make the household immune to falling markets, nor does it guarantee that prices recover before the cash runs out. It changes which asset pays the bills, while the decline remains severe. So the Tuesday when the two approaches split is the first payment date after the 6-month pile has been consumed. The market may still be falling. It may be bouncing around well below its old level. Either way, the emergency fund no longer stands between your recurring expenses and the sell button, while the crash reserve still carries another 30 months of planned withdrawals. The label on the account is not what creates protection. Your spending receives the same dollars whether they came from cash or from an investment sale. The difference sits on the other side of the transaction. Shares left inside the portfolio can participate in a later recovery, while shares exchanged for utility bills and groceries are gone. That gives you a practical dividing line. If the financial problem ends when employment income resumes or a one-time bill gets resolved, you are funding short-term household liquidity. If the monthly gap continues because investments have permanently taken over part of the paycheck's old job, every withdrawal date carries market price risk. If this distinction is useful, clicking subscribe helps a lot. Thanks to everyone who does. It supports more of this mildly annoying financial arithmetic. Calling both amounts cash savings makes them sound interchangeable, but they protect different things. The emergency fund protects your household from needing money quickly. The crash reserve protects long-term ownership from being converted into spending money while market prices are depressed. The remaining issue is the cost of that conversion. When a $50,000 withdrawal collides with a 50% market decline, how many shares must you surrender to keep the household running? Picture a $1 million portfolio as 100 equal ownership units. At the starting price, each unit is worth $10,000. To produce the annual gap already on the table, you sell 5 units, leaving 95 invested. Now cut market prices in half. Each unit is worth $5,000, so the identical withdrawal consumes 10 units. Your housing did not double. Food did not double. The cash reaching your checking account did not increase by a cent. Yet the exchange rate between lifestyle and ownership became twice as punishing. A percentage return chart can obscure that damage. The chart may later show a full recovery, but your portfolio no longer owns all the units that experienced it. Run the recovery with clean arithmetic. A 50% fall takes 100 units from $1 million to $500,000. Returning from $500,000 to $1 million requires a 100% gain because the increase starts from the lower base. If you retain all 100 units, every unit participates in that doubling. Sell 10 units near the bottom though, and only 90 remain. When the unit price climbs back to $10,000, the index has recovered to its old level while your account holds $900,000. The $50,000 you withdrew paid bills and disappeared into normal life. It is no longer invested, and the 10 units exchanged for it cannot take part in the rebound. Compare that with taking the same withdrawal before the decline. At $10,000 per unit, you give up 5 and keep 95. If prices later return to the starting level, those remaining units are worth $950,000. Same spending and same eventual market price. Yet the recovered account differs by $50,000 because of the price at which ownership had to be surrendered. Real retirees do not make one tidy sale on an annual anniversary. Bills arrive throughout the year, withdrawals may occur monthly, and prices move between transfers. The unit model strips away that noise, so you can see the cause. Lower prices force each dollar of spending to consume more of the portfolio. The $25,000 reserve pays only half of that annual gap. It can prevent some low-price sales, but once its 6-month runway ends, the ownership exchange resumes if the decline continues. The $150,000 reserve keeps the same recurring spending away from depressed shares for 3 years. Its value is not the cash alone. It is the collection of units you never have to sell while their quoted price is crushed. Cash does not need to predict the precise low for this to work. It only has to remain available on withdrawal dates when selling would demand an abnormally high unit count. Some transfers will occur above the bottom, while others will happen below earlier prices. Avoiding the worst exchange rates preserves more ownership for the eventual climb. That is why saying the market eventually comes back gives an incomplete answer to someone living from the account. Markets recover by repricing assets that remain in the portfolio. They do not recreate units already sold for property taxes, insurance, groceries, or electricity. Recovery belongs to remaining ownership, not to the balance you remember seeing before the decline. I became slightly obsessive about timing after more than 10 years running my own business around accountants and fiscal lawyers. They taught me to follow how money actually moves rather than admire a tidy percentage in a projection. I also have multiple hundreds of thousands of dollars invested, so this is not a classroom puzzle I can forget after recording. I read the dull source documents because plans often break where a long-term average meets a bill due now. The arithmetic proves that short and long reserves can leave you with very different unit counts, even when the index eventually reaches the same destination. It does not prove that the longer runway matches real crashes. For that, the relevant clock starts at the market peak and runs until the deepest selling prices arrive. Have severe declines actually stayed on the way down long enough for 6 months of cash to expire? The financial crisis answers yes. The S&P 500 price index peaked on October 9th, 2007, then fell approximately 56.8% before reaching its trough on March 9th, 2009. That descent lasted 517 calendar days, or roughly 17 months. A 6-month reserve would have run dry around 11 months before the market reached its lowest price. 11 months is a long exposure when the portfolio must keep producing money for housing, food, utilities, and taxes. Each uncovered withdrawal during that stretch would meet shares worth less than they had been when the reserve began. The 36-month reserve would still have held about 19 months of runway at the trough. You wouldn't have needed to identify March 9th as the bottom, and you couldn't have known it was the bottom while living through it. Cash would have continued funding the gap because the reserve had separated scheduled spending from the market's daily price. That result is uncomfortable for the 6-month approach. It expired before the worst selling price arrived, even though half a year sounds cautious when markets are calm. 6 months still provided useful protection during the opening portion of the decline. Then it transferred the funding burden back to the portfolio while prices kept falling for almost another year. A slower collapse puts the longer reserve under more pressure. The S&P 500 price index began its technology era decline from the March 24th, 2000 peak. It didn't reach its trough until October 9th, 2002. The index lost approximately 49.1% across 929 days. That was slightly more than 30 months spent moving from peak to trough. 6 months of cash would have covered less than 1/5 of the descent. Afterward, the household gap would have returned month after month while the market continued grinding lower for about 2 more years. A 2.5-year reserve lands near that trough because 2.5 years equals 30 months. A full 3-year reserve extends beyond it, leaving several months of cash after the deepest price arrived. That places 3 years at the protective end of the established 2.5 to 3-year retirement cash range. It isn't an argument for unlimited cash. The range has a defined assignment. carry portfolio-funded spending through a severe descent when each withdrawal can consume an unusually large amount of ownership. Extending the reserve indefinitely would require a different justification. These declines are historical boundary tests, not predictions of the next crash's shape. A future bear market could fall faster, recover sooner, stall longer, or move through repeated rebounds that fail. History cannot give you next Tuesday's market price. It can show whether a reserve would have remained available through conditions investors already endured. Against both descents, the shorter pile expired well before the trough. The 3-year pile remained available when prices reached the point at which selling was most expensive in ownership terms. That consequence lands directly in your account. After the shorter reserve runs out, every uncovered month creates another funding decision. If outside income cannot carry the gap and spending cannot contract enough, ordinary bills force another sale at the price then available. A long descent can therefore turn the 7th withdrawal month into the beginning of repeated ownership losses rather than one isolated bad trade. Still, both episodes create an awkward objection. Reaching the trough isn't the same as regaining the old high, and both markets took longer than 3 years to recover their previous peaks. If cash ends before the index fully recovers, why isn't even the larger reserve too small? Because the old high is the wrong finish line for this reserve. During the financial crisis, the S&P 500 didn't establish a new closing high until March 2013. That came about 5.5 years after the October 2007 peak, and roughly 4 years after the March 2009 trough. Holding enough cash for that entire period would have avoided stock sales until the index crossed a ceremonial marker on a chart. Yet a new record has no special power over your household. Your bills don't change because the index sits barely below its former high, and they don't become safer the morning it moves above that level. Withdrawal damage changes as prices move. Near the bottom, each spending dollar claims the largest amount of ownership. As prices rise, the same withdrawal consumes fewer shares, even before the index finishes recovering. A reserve aimed at the most punishing exchange between ownership and spending therefore follows a different clock from one aimed at waiting for a record. Its job is to carry your monthly gap through the period when forced sales cost the most units. It protects against destructive withdrawal prices rather than every market price below the previous peak. You could hold 5.5 years of spending. You could hold 10. At some point, however, the extra cash stops protecting the same shares and starts displacing assets intended to pay for later decades. You have moved beyond funding a known danger window and created a larger, lower volatility allocation, whether you intended to or not. 6 months and 3 years are not weaker and stronger versions of identical insurance. 6 months primarily handles an interruption in household cash flow. 3 years handles the interaction between retirement withdrawals and a prolonged market descent. That distinction changes how you judge the additional cash. Extending the runway through the period of unusually expensive share sales can preserve ownership. Extending it until an index prints a new record may require several more years of spending without providing protection in proportion to the money committed. Once the dangerous window has coverage, additional cash begins competing with long-term assets rather than protecting the same shares again. That competition carries a measurable cost, even when cash yields look respectable on the statement. In August 2026, 3-month Treasury bill yields ran at approximately 3.7 to 3.9%. Consumer prices had risen 3.5% over the year ending in June. Near the upper end of that yield range, purchasing power grew only narrowly before taxes. And the quoted yield doesn't stay attached to the reserve forever. A 3-month rate resets as bills mature. If short-term rates decline, the next maturity enters a different yield environment, while household spending keeps arriving on its own schedule. None of that makes reserve cash defective. It has a job that long-term assets cannot reliably perform on demand, paying a known monthly gap without requiring a sale at a rotten market price. Comparing every reserve dollar with the expected return of stocks ignores the cost of being forced to sell those stocks when their price has collapsed. The waste begins when the balance keeps expanding without a defined withdrawal window attached to it. Then caution can quietly become permanent underinvestment. You accept lower expected participation for years after the sale pressure the reserve was designed to absorb has eased. Long-range retirement guidance tends to express spending and returns in annual percentages, which makes the projection tidy while leaving the calendar strangely blank. It can show an account lasting for decades without marking the date when earned income stops paying the bills and investments must begin producing cash during a decline. That missing date changes the meaning of a market loss. During the middle of a career, falling prices and household spending can remain separate events. Near retirement, they may arrive in the same account at the same time. Why does that omission become far more damaging the moment your paycheck stops carrying the monthly gap? Because a worker owns a shock absorber, that retirement projections often leave off the page, next month's earned income. The same 50% decline can slash the displayed portfolio balance, yet the paycheck continues handling ordinary life. You can leave depressed holdings alone because your groceries and housing aren't waiting for a brokerage transfer. Once withdrawals begin, the account has two jobs at the worst possible moment. It must endure the decline and produce spendable cash on schedule. The annual gap we examined keeps arriving regardless of market conditions. So the unit exchange becomes destructive when routine transfers continue after prices collapse. A bad return turns into lost ownership only when spending forces a transaction. Two households can therefore hold matching portfolios through the same bear market and experience different damage. One household pays its bills with earnings and retains its position. The other needs the portfolio to function as a paycheck, so every withdrawal exposes more of its future recovery to current expenses. The market event is identical. The demand placed on the account isn't. Then your brain joins the problem. During working years, a falling balance can feel distant, unpleasant, but abstract. In retirement, that balance represents years of future housing, food, taxes, utilities, and insurance. You begin translating every red number into bills that still need payment. The urge to intervene grows precisely when giving up ownership costs the most, because selling feels like stopping the fall, even though it locks part of the damage into your unit count. Cash changes the decision by removing the deadline. It doesn't tell you whether Tuesday is the low, and it doesn't need to. If Tuesday's expenses already have an assigned funding source, you can let the market remain unresolved without turning fear into a sale. That psychological distance matters because humans are terrible at sitting still when a declining account has become the household payroll department. Standard Retirement Advice gives you several respectable assignments. Max a 401k, choose an allocation, and apply a 4% spending rule. A plan can do all of that and still enter retirement with the same 6-month cash balance it carried during employment. The paperwork often treats cash as a static allocation instead of a shrinking runway tied to withdrawals. An accumulation plan then reaches retirement without changing its operating rules, even though the portfolio has inherited the paycheck's old responsibility. Knowing the reserve number and building a coordinated system around it are two different jobs. I built a digital book called the Exit Code because the gap between them matters most when withdrawals begin. It takes 50 years of retirement data and distills it into a mathematical framework for exiting the rat race. The 4% trap deals with plans that look sound in annual averages but stumble when cash is needed during a crash. The dynamic withdrawal method connects spending to market conditions, while the lazy portfolio focuses on keeping ownership in the recovery instead of chasing forecasts. Those pieces belong together. A reserve without a withdrawal policy can be drained badly, and a portfolio without runway can be sold badly. The book costs less than 1 hour with a mediocre financial advisor and is available through the link in the description. It is the operating framework behind the arithmetic we're using here, rather than another calculator that ends at a success percentage. Exposure begins when earned income stops carrying the recurring gap. Before that transition, cash mainly protects the household while the portfolio waits. Afterward, each uncovered month may require investments to produce money at whatever price the market offers. Account size alone cannot settle the question. A larger balance with no outside cash flow can face more immediate withdrawal pressure than a smaller balance whose owner is still earning enough to cover ordinary life. So the reserve has to match the source assigned to the next bill, and that assignment can change before or after the retirement date printed in your plan. The dividing line is the moment earnings stop doing the work and the portfolio becomes responsible for the monthly gap. That moment rarely arrives as one clean handoff. Your birth date doesn't decide which reserve you need. The source assigned to next month's spending does. While earned income still covers recurring bills, 6 months of cash mainly protects against an interruption. The portfolio can remain invested because it hasn't yet become the household paycheck. Retirement plans tend to assume that transition happens on the chosen final workday. An involuntary income loss can move it forward. If earnings stop before the planned date and don't resume, a temporary liquidity problem becomes an early retirement withdrawal problem. Cash can expire before the portfolio was supposed to take over, leaving depressed assets responsible for a schedule they weren't meant to fund yet. That makes the years approaching retirement different from the middle of a career. Liquidity needs to evolve before the last paycheck arrives. As the probability of relying on investments rises, the reserve moves away from 6-month interruption coverage and toward the established 2.5 to 3 year range. The technology decline we tested shows why the upper end exists. A prolonged descent can outlast the employment-oriented reserve by years. Your target changes again whenever independent income starts or increases. For each relevant date, subtract dependable monthly income from recurring monthly spending. The remainder is the portfolio gap that the reserve must carry. Don't measure future runway against income that hasn't started arriving, because money promised later cannot pay a bill due next month. Once that income begins, the cash balance can stay unchanged while its coverage expands. A smaller portfolio gap means each month consumes less reserve, so the same dollars buy more time. The reverse is equally important. If recurring costs increase while outside income stays flat, runway contracts even when the statement balance looks healthy. A reserve can drift from crash protection towards short-term liquidity without losing a dollar. Spending flexibility affects the clock as well. A household that can postpone travel, reduce optional purchases, or suspend large discretionary projects during a decline uses cash more slowly. A household whose gap consists mostly of housing, taxes, food, utilities, and insurance has less room to adapt. That rigid portion deserves the closest attention because market prices cannot persuade the mortgage company to wait. You can locate yourself by asking who funds ordinary life now and who would fund it if earnings stopped earlier than planned. If the answer remains your paycheck, you're closer to the 6-month side. If recurring transfers already come from investments, you're on the crash reserve side. Between them lies the awkward transition where employment still exists, but losing it would immediately turn the portfolio into payroll. By the way, subscribing helps support this kind of source-based analysis, so thank you to everyone who clicks it. Now back to the reserve, because choosing the right amount doesn't guarantee that it will work. A correctly sized cash pile can still sabotage its own purpose if you measure it as a sacred dollar balance or replenish it during the decline. If keeping the reserve full requires selling depressed shares, the protection has been reversed. The remaining question is operational. What rule decides where next month's money comes from when the market is already falling? Treat the reserve like a runway gauge, not a museum exhibit that must remain untouched. On each statement date, divide the cash assigned to recurring portfolio withdrawals by your current monthly portfolio gap. The result is runway expressed in months. It may read 6, 36, or anything between them. That measurement matters more than the displayed balance because changes in spending or independent income alter your coverage immediately. During a weak market, expect the gauge to fall. Cash leaving the reserve for scheduled living costs means the plan is doing its job. Selling depressed shares to make the cash balance look full again reverses the protection. You have surrendered ownership at an ugly price and routed the proceeds through a cash account for cosmetic comfort. Refilling belongs in favorable periods, when portfolio gains, excess income, lower withdrawals, or ordinary rebalancing can restore spent runway without demanding a sale near the bottom. You don't need to recognize the lowest market price while living through it. You need a rule that allows cash to be consumed during the decline and rebuilt after funding conditions improve. Keep emergency expenses separate from recurring retirement spending in your records, even if both pools sit in the same account. A one-time repair is an emergency withdrawal. Housing, groceries, taxes, and utilities belong to the monthly portfolio gap whenever independent income doesn't cover them. Folding an isolated bill into permanent monthly spending distorts the runway calculation and reserves cash for a cost that won't repeat. Availability also differs from assignment. Cash already earmarked for another obligation cannot support future monthly withdrawals. Counting the same dollar twice creates fictional runway, which tends to look reassuring until two bills arrive. Apply the Tuesday test. Write down the answer to one uncomfortable question. If the S&P 500 were down 50% next Tuesday, and the descent continued for the 929 days already tested, what would fund your monthly portfolio gap after month 6? Name the account or income source rather than promising that you'll adjust later. If month 7 requires selling stocks, your household owns an emergency fund. That may fit while earnings still cover ordinary spending, but it doesn't create crash runway. If cash continues funding the gap through the robust end of the 2.5 to 3 year range, you have a crash reserve. And the amounts aren't additive. A 3-year reserve already contains its opening 6 months. You don't need a separate 6-month pile stacked beside it. The operational difference appears after that opening period ends, when one household begins selling investments and the other continues drawing from its remaining runway. On the real Tuesday, let the reserve pay the scheduled gap while the adverse window it was built for is underway. Its balance is supposed to shrink. Better markets can later provide room to rebuild it without pretending you called the bottom. Lazy investing built more fortune than crypto memes. The market cannot control which asset pays your next bill, unless the plan leaves no alternative. 6 months buys time to solve a household interruption. 3 years protects ownership through a severe descent. The useful number is the one tied to your actual monthly gap.